Welcome to Behind the Doors, the podcast where we take you behind the scenes of residential real estate investing. I'm your host, Dan Noma Jr., here with my co-host, Marvin Cruz.
We're here to help you unlock the best strategies and practice for investors. Whether you're just starting out or you're a seasoned pro looking to scale your portfolio.
We've spent decades navigating the ever-changing world of real estate, and now we're sharing everything we've learned to help you succeed.
From off-market deals to cash flow management and everything in between, we'll break it down and bring you actionable insights that can make a real difference in your investments.
So get ready to open the door to new opportunities and take your real estate investing to the next level. Let's dive in.
You know, we talked about sales and new properties coming on board, but sales is also closely intertwined with mortgage rates as well.
Huge.
And both of these influence each other. Can you talk about how rates and sales influence each other? And then we'll deep dive into rates impact.
Yeah, for sure. I think that it's more that rates cause the reaction in sales versus the other way.
Gotcha. Yep.
Right?
Yep.
Sales
Makes
don't
sense.
really cause a reaction in rates.
Yep.
But rates. So like starting with rates, thinking about rates, right? When rates are low, affordability becomes able, right? Like
Yep.
you can now afford a mortgage payment of X amount because the interest rate is 3%, 2%, whatever. Now, you typically during those periods of time, you see home prices going up, right? So people are, getting in at a low interest rate, homes appreciating, all of that's great.
Right.
What we got going on now, right, is we have high interest rates, or what we've had going on for the last 2 years really is high interest rates. So high interest rates cause people to second guess the casual move, right? Like most consumers are not moving or selling because they'd be trading rates, right? There was a statistic that said that over 80% of home mortgages today in the US are below 4%. So existing home mortgages are below 4%.
Right. And right now, we're at 6.78.
7. Right?
Yeah.
Like,
Today
today
yeah.
it's 7. I saw a rate sheet today and they were touting 7% rates.
Oh, wow. Yeah.
So if you're going to trade your 4% rate, 2% rate, whatever, for a 7% rate, you better have a really compelling reason to move, right? And typically you would do that if home values were going down. You know what I mean? Because now, like, you're trading into a different asset
Yeah.
that you can afford still. If you do that rate now, that's what's caused a lot of people to hibernate is because, they're not, what are they going to sell? They're going to sell, get a bunch of equity and invest it into a super high interest rate house that's at the peak of home values. I get it. Like, I get it. I get why people are holding firm on their values. But I think you brought something up earlier. You were talking about like debt and how the debt ceiling in the country is super high.
Yeah.
And here we're talking about like credit card debt, student loan debt, like external debt.
Yep.
That's the factor that's now causing this rate of people that are putting their properties on the market. Right. So we talked about that in the markets that we serve in. There's a 34% increase in the number of new listings in the market. So supply's hitting the market.
Yep.
Well, that's what you're dealing with. There's a lot of people that are, in a situation where they financially have to relieve something, right? They've got to get access to the equity in their home. And so in order to do that, they got to sell.
Gotcha. Gotcha. Yep.
And that's a big percentage of the people that are selling right now are people that have to sell. The one that wants to sell, if you're going to get a mortgage, today's, maybe not the greatest time ever to consider that. Now, the caveat to that, right, is that you have to make an assumption that rates are going to go down at some point.
Yeah.
That is the part that like I focus on with our clients a lot is the fact that interest rates are high and property values are arguably at highs. But what if interest rates go down a little bit and property values continue to go up due to housing supply? Now you're in a situation where property values went up interest rate went down and I was sitting on the sidelines and I have to now pay more for that property. So it's like, what do you do?
Yeah.
Do you take the lower rate tomorrow,
Yeah.
or do you focus on the purchase price today?
Yeah.
It
Feels like you focus on and correct me if I'm wrong, but I'm
Yep.
thinking focus now, refinance later.
Yeah, you hear that a lot,
Yeah,
right? And
yeah.
we're not financial,
Yeah.
we're not financial advisors, but that makes perfect sense, right? Is, again, you've got to have some sense that interest rates are going to go down, mortgage rates are going to go down, not Federal Reserve rates. Like, I think there's a lot of confusion that the two are the same, or
Yeah.
that when the Federal Reserve cuts interest rates, that correlates directly to mortgage rates. Two are two totally different things. Mortgage rates are associated to bonds, right? Treasury bonds,
Yeah.
U.S. Treasury bonds. And someone's got to buy those bonds, and there has to be a bond market available. There's got to be a yield there. Well, for the longest time, in the last 18 months, there was no market. The only people buying bonds was the federal government themselves. That creates a non-competitive environment. Mortgage rates have no choice but to go up as a result, right? As it gets more competitive, I'll pay less for that bond, that group of mortgages,
Yeah.
right? Because you and I are competing for
Yep.
that. That creates competition. I'll pay less for that one. That's how the bond market works. That's where we've struggled
Yep.
in the country, is that the bond market, and usually people that are buying bonds are like foreign companies or foreigners. Big foreign entities will buy U.S. securities. They'll buy U.S. bonds, mortgage bonds, because you're technically owning a bunch of U.S. real estate as a result. And that's a really sound and safe investment. Well, COVID caused a lot of these countries to struggle for a while, right? And as a result, you're seeing the results of that now in a higher interest rate,
Yeah.
because there's not a big demand in the bond market.
Yep. Yep.
But I think the good news is that it's stabilizing. We're starting to see some activity in the market. And as a result, interest rates will go down a bit. But the days of, like, if you're sitting back and you're waiting today for a 3% mortgage rate, I think you're going to be waiting a while. And again, I'm not a forecaster. That's not it.
Yeah.
I just look at math and statistics and I'm going, it just doesn't, short of another pandemic,
Yeah.
there's just not really a scenario in which you would see mortgage rates drop that low again. So, to our earlier point, buy now, refinance when the rate comes down a little bit,
Yep.
but buy now because the home price is better now than later on when the home price is higher.
Yep.
Because refinance you can always do, but
Yep.
you can't just go back in time and buy the property at a different price. You're going to pay more for that house later on.
Yep. But we're not financial advisors, but we definitely tell you to consult your financial advisor. But we are saying, though, it is imperative that you understand market trends and market rates when you're making your investment decisions.
Yeah. Yeah. I think you got to keep an eye on all of these factors, right? And I think one of the cool things that our system offers our clients is the ability to dive into all of this data.
Yep.
Whenever they want to, right? They just log in, look at an asset, and they can see all the demographic data. They can see all the economic data of that market. I mean, all of that data is available to them. And I think, that's been my thesis from day one, is that if you're going to invest in real estate versus just live in real estate, two different things in my book. And I think if you're investing in real estate to try to create something from it, like, do your homework. Just learn about what you're actually doing. Don't take it on a subjective kind of view of somebody going, I think this is a great place to invest.
Right.
Or I think this is a good time to invest. Let's quantify it. Let's just quantify it. And then again, I'm no expert, right? But what I'll do is I'll quantify the data for you so you can go, yeah, I like the way that sounds, or I don't like the way that sounds, but it's data driven versus subjective choice.
Thanks for tuning in to another episode of Behind the Doors. We hope you found today's insights valuable for your real estate investing journey.
Remember, real estate success doesn't happen overnight, but with the right tools and strategies, you can build long-term wealth and create passive income.
If you enjoyed the show, be sure to subscribe, leave us a review, and share it with others who are passionate about real estate investing.
Don't forget to follow us on social media for more tips and exclusive content.
Until next time, keep unlocking new opportunities, and we'll see you on the next episode of Behind the Doors.